The market is currently closed with NVIDIA stock finishing its last formal trading session at a closing price of $219.22 per share, reflecting an upward intraday movement of 3.44% or $7.28. Looking at the after-hours session, the price edged slightly higher toward $220.70. Right out of the gate, most people looking at this ticker see a company operating at full throttle, virtually immune to broader economic slowdowns and locked into a perpetual upward trajectory. But if you strip away the immediate price action and look at the structural mechanics under the hood, the standard retail story misses the real point entirely. Wall Street is currently treating this asset as a pure, unlimited software utility play, yet the actual balance sheet dynamics reveal a high-stakes hardware supply chain balancing act, where capital expenditure timing, foundry capacity limits, and custom silicon alternatives are actively rewriting the risk profile. Investors hopping on their favorite online investment applications often assume that buying NVIDIA stock is simply an automatic bet on the entire future of computing. But expectation rarely matches structural reality without a few friction points along the way. The general belief dominating retail financial forums, YouTube channels, and everyday investment help discussion boards is simple. Enterprise demand for graphics processing units is infinite, and no competitor can ever catch up. That is the baseline expectation. Everyone looks at the towering market cap, the parabolic quarterly revenue figures, and concludes that owning NVIDIA stock in an individual brokerage account is a guaranteed winning strategy for the next decade. But here is the contrarian reality you need to consider before placing your next order through Robinhood stock trading or SoFi Invest. While NVIDIA stock remains the uncontested engine of accelerated hardware, the enterprise customers spending tens of billions on these systems are facing their own return on investment timelines. Big tech hyperscalers cannot continue expanding their capital expenditures at a 90% annualized rate indefinitely without showing massive software monetization from their end users. When cloud providers start optimizing their existing server clusters or shifting a larger percentage of workloads to internal ASIC chips, the marginal demand for third-party GPUs will naturally normalize. That shift from hyper-growth expansion to cyclical maintenance capital expenditure is where expectations and reality are going to collide hard. To understand where this stock goes next, we have to inspect the immediate daily trading activity and volume trends happening right now. Across major trading networks, Interactive Brokers platform metrics show heavy institutional participation, with over 150 million shares changing hands in the latest full session alone. What stands out isn't just the sheer liquidity, but the concentration of options contracts surrounding critical strike levels. Institutional money is using complex hedging structures across various Fidelity brokerage accounts and Interactive Brokers stock trading accounts to lock in gains while simultaneously writing call options against long positions. This options activity creates an artificial volatility dampener, causing the stock to consolidate tightly after massive leg-up rallies. When you look at intraday order flows on platforms like Robinhood Investments or SoFi Active Investing, retail buying surges on minor dips, but institutional volume tends to step in during high volatility breaks near support levels. The institutional side isn't buying out of simple FOMO. They're executing systematic portfolio rebalancing routines through automated platforms like Schwab Intelligent Portfolios and Fidelity Wealth Management setups. Comment below how many shares of NVIDIA stock you currently hold in your portfolio and whether you are buying more at current levels. Beyond the daily price swings and short-term options flow, let us ground this analysis in what the business actually does and how its revenue engine operates. Strip away the market hype, and NVIDIA Corp is a fabless semiconductor designer that built its empire by transforming parallel processing from a specialized gaming niche into the core infrastructure of modern computing. Their core business model relies on designing highly complex graphics processing units and outsourcing the physical manufacturing to semiconductor foundries like TSMC. However, the true moat isn't just the silicon architecture itself, it's the proprietary CUDA software environment created 2 decades ago. CUDA forces developers to build complex applications specifically optimized for NVIDIA hardware, making it extraordinarily difficult for enterprise clients to switch to alternative chips without rewriting millions of lines of software. The company generates revenue across 4 main segments: data center, gaming, professional visualization, and automotive. The data center segment now accounts for the vast majority of top-line revenue, driven by massive purchases of high-performance compute clusters from cloud giants, research institutions, and sovereign nation-states establishing national compute capabilities. To put the current financial performance into clear focus, we have to look at the recent earnings trajectory compared to historical baselines. Over past quarters, quarterly revenue numbers have repeatedly shattered consensus estimates, growing from modest single-digit operational gains years ago to generating massive $10 billion per quarter in net income. Operating margins have expanded significantly, sitting at levels typically seen only in high-margin SaaS companies rather than physical hardware developers. However, historical performance also highlights the cyclical nature of this industry. In previous tech cycles, inventory buildups in the channel caused sharp, painful pullbacks in share price, reminding investors that even dominant chip designers are vulnerable to inventory bullwhip effects. When crypto mining demand collapsed years ago, or when gaming GPU supply caught up with consumer demand, the stock experienced drawdowns exceeding 40%. Investors utilizing self-investing strategies on Robinhood app, SoFi trading platform, or Fidelity mobile app often forget those historical drawdowns because the recent AI rally has buried past volatility under record highs. Looking forward, the fundamental path for NVIDIA stock hinges on specific catalysts, regulatory pressures, and market risks that every serious investor must monitor. On the catalyst side, the ongoing rollout of next-generation architecture platforms presents a massive revenue replacement cycle. As enterprise data centers upgrade from legacy architectures to newer, higher-efficiency compute nodes, average selling prices per rack unit continue to climb. Furthermore, the expansion of software services, enterprise AI deployment tools, and digital twin simulation platforms creates high-margin recurring revenue streams that could eventually smooth out hardware cycle swings. If you manage your assets through a Fidelity trading platform, an Interactive Brokers account, or a SoFi robo-advisor, tracking the percentage of recurring software revenue versus hardware sales will be one of the most critical metrics over the next 8 quarters. However, the risks facing this growth narrative are equally significant and directly challenge the permanent dominance expectations. The primary risk is custom silicon development by the company's largest customers. Cloud giants like Microsoft, Amazon, Alphabet, and Meta are spending billions developing their own custom accelerators. While these proprietary chips might not match top-tier raw performance, they are significantly cheaper to operate for specific, predictable workloads. Every custom chip deployed in a major data center is a high-margin GPU sale lost. Additionally, geopolitical trade restrictions continue to limit the addressable market in major foreign regions, forcing custom hardware revisions that yield lower margins. Supply chain bottlenecks, particularly in advanced packaging capacity, also restrict how many units can be delivered in any given quarter, setting a physical ceiling on near-term revenue upside, regardless of customer demand. When evaluating how to handle this asset within a modern portfolio, strategy and platform selection play a major role. Investors taking an active approach often utilize platforms like interactive brokers due to low interactive brokers' fees, advanced charting, and robust international market access. Others who prefer structured, low-maintenance approaches rely on intelligent portfolio systems, Fidelity ETFs, Fidelity mutual funds, or automated options like SoFi ETFs and Robinhood Cash Management to balance out their high-beta tech exposure. For those managing long-term retirement accounts through Fidelity IRAs or constructing a diversified individual brokerage footprint, balancing single-stock tech risk with broad market stability remains the ultimate goal. Online investing makes execution instant, but platform accessibility should never replace disciplined risk management and deep fundamental research. In summary, the expectation surrounding NVIDIA stock is that its exponential earnings growth will continue uninterrupted as world infrastructure converges